Hi everyone, in this video we will be covering the accounting cycle. Before we do that, let's review a couple of fundamental items. First of all, our debits and credits. Remember that debit in accounting means the left-hand side of the account, whereas credit means the right-hand side of the account, abbreviated as DR and CR. The accounts that increase on the left-hand side or debit side of the account will automatically decrease on the right-hand side. Accounts that increase on the credit side or right-hand side then will decrease on the left side or debit side. So I suggest you try to remember which accounts increase on which side, and they do vary as you see here on the screen, and then you know that automatically they will decrease on the other side of the account. So when you need to record a journal entry into your accounts, then you need to decide, does it increase or decrease, and then that helps you to determine whether you need to debit or credit that account. So these are some accounts that normally have a debit balance. Those are going to be your asset accounts, expense accounts, dividend. Now, could they have an abnormal account? Certainly. Remember that cash is an asset account and sometimes cash is overdrawn, so it is what it is. But normally, typically, the normal balance will fall on its increase side, which is the debit side. Those accounts that have a normal credit balance are liability, revenue, and equity accounts typically, and the same information follows with that. One simple way to help remember that is DEA-LER, so that's just picking up the first letter of each word there you see on the screen. That might help you to remember that. So if it does, just use it. If it doesn't, just disregard it. Also remember there are 5 basic categories of accounts: your assets, liabilities, equity, revenue, and expenses. To journalize, sometimes we overlook and just assume students know what that means. It just means to record it or write something down, write down the transaction in a journal. So to journalize is just to write it down. The basic accounting equation: the total of the assets at any given time must be equal to the total of all the liabilities plus the equity accounts. And remember that there are 2 parts to the equity: your common stock, which is your paid-in capital, and then retained earnings. Expanded accounting equation: now we need to bring into play those accounts that do impact the equity account, what the company is in the business of doing. Revenues, which is an increase to the equity account. Expenses, which decrease the equity account, and then dividends, if they are paid out, would also be a decrease to the equity account overall. And in future videos, you'll see how those play out. So here are some notes on the basic accounting process. The first item is that you want to identify some transaction has occurred that affects the accounting equation. Perhaps an invoice or some other document will come across your desk and you realize that this has triggered a transaction. You need to identify what happened. So step 2 is which accounts are affected. At least 2 will be impacted for the debit and the credit side, but there could be others. If you're preparing a payroll entry, you might have a dozen accounts that are impacted. It's fine. We just figure out the debit and credit side, make sure it's in balance, and we prepare that entry. And it could be, as you're analyzing accounts, don't get hung up thinking that as one account increases, the other automatically decreases, because that's not always going to be the case. Think of an example like supplies. If you go to a supply store and you buy a lot of supplies, you bring them back and store them in the cabinet or closet, the amount of supplies would have increased, but perhaps you didn't pay for them yet. So you have an accounts payable, a liability, where the amount that you owe now has increased. So that would be an increase to an asset and a liability account. So don't get hung up thinking something always increases and the other side is something decreases, because it's not true. Any number of things could happen. Both accounts could be decreasing, both could be increasing, or you could have it be one and then the one increases while the other decreases. But you figure out which accounts are affected, what happened to them, do they increase or do they decrease, and then go back to your debit credit rules to help you figure out whether you need to debit the account or credit the account. The third step now is to journalize or record or write down that transaction based on your analysis. We use double entry accounting. That means that the total on the debit side has to be equal to the total on the credit side, if you are not in balance with your transaction, all of your records are going to be out of balance. They're going to, this is called a trailing error. They're going to trail with you through all the way to your financial statements, which is basically your end product. So keep in mind that the transaction must be in balance, otherwise you're going to have problems. Next, you post to ledger accounts. So you're posting each entry from the journal to its ledger account. Now, the good news is once you have decided whether it's a debit or credit in the journal entry, it posts into that ledger account in the same way. The ledger account is set up like our T accounts with a debit on the left and credit on the right. So if you've prepared your journal entry correct, then as you post into that ledger account, you should also be correct. You'll post into at least 2 accounts and perhaps more. In the end, you'll have numbers on both sides. You can't leave it that way for some accounts. You have to have your ending balance, and I'll demonstrate how you do that in a future video. You tally the account to arrive at your ending balance, and now you want to prepare something called an unadjusted trial balance. This is an interim report that you prepare. You're bringing in all of those in balance from the ledger accounts, and notice it must be in balance. If it is out of balance, you've got to go back to the drawing board. You've got to go sometimes track all the way back to your journal to see if you journalized something incorrectly. If you are in balance with your unadjusted trial balance, then you go forward and prepare your end of the period adjusting entries and post to the ledger accounts. Adjusting entries are those items such as depreciation expense that has not been recorded for the period. Some of the supplies in the cabinet have perhaps now been used up, and so you want to record that portion as a supply expense. Your prepaid account, if you have prepaid insurance or prepaid rent, some of that has probably expired now, so you'll want to recognize the expense side of that and decrease the asset. Unearned revenue would be another one. If you have some unearned revenue that is in your liability accounts, money that has been paid in advance of performance of the revenue, now hopefully you have earned some of that, so you'll want to recognize, make an adjusting entry to recognize that. Or recognize if you have customers that owe you, you're ready to send out invoices, and that has not been recorded yet. So you'll want to make all of those adjusting type entries into your, you'll prepare them and record them as journal entries, and then post those to the ledger accounts as well. Prepare new balances. You're going to retally those ledger accounts and prepare an adjusted trial balance now. Again, from the adjusted trial balance, you have to be in balance, otherwise there's a problem and you need to go find that problem or that error and correct it and go forward. If you're in balance, now you're ready to prepare the financial statement. So for us in financial accounting, this is our end product. Everything that we do is to get these financial statements to the users, people who need to use these financial statements, such as creditors or investors in a company. They will use these statements to help them make decisions. This is why it's so important for us to be accurate in our reporting. And also in accounting, we err on the side of conservatism. If we're not sure if revenue has been earned yet, then don't report it. If we are, on the other hand, with expenses, if we're not sure if we owe that, but we're pretty sure we do, then we should record that expense. Err on the side of conservatism for your reporting. The financial statements are prepared in order, and notice I don't discuss the statement of cash flows in this particular statement in this particular video, but I will have another video on the statement of cash flows, but it is one of the 4 statements that you would prepare as well. But for here, I just want to cover income statement, statement of retained earnings, and your balance sheet. So they're prepared in this order. Income statement first. This is a report. We're not concerned with debits or credits anymore. We want good form, nice, neat. We want it produced like it is normally produced. So if you're in class now, you have a textbook, go out and find an example of a usual good form income statement and then prepare yours in such fashion. You will list all of the revenues and total them up. Companies can have more than one revenue. You'll have an area for expenses. You'll list every expense account and their amount, the total. You don't just bring in one total that says expenses. You list each of the expenses and then total that up. and then you will net that. Also notice that you can prepare a multi-step versus a single-step statement. If a company has cost of the goods sold, then, or if they have discounts that are allowed for their sales, then a multi-step is usually the better way to go. It provides more information to the users of those statements. So multi-step, single step, you would omit some steps. Again, your textbook, if you're still in class, should have some examples of that. After that, you will prepare a statement of retained earnings. In some of your more advanced courses, you'll begin to talk about one that's called Statement of Shareholder Equity and Statement of Comprehensive Income. But we're talking about the basic now, which is your Statement of Retained Earnings. So consider, to calculate this statement, you'll consider, is there a beginning balance? If it's a brand new company, the beginning balance would be 0. Also notice that the end balance from the prior period, say December 31st of the prior year, that becomes your new beginning balance on January 1st of the current year. Sometimes you're only given the date, so you have to look at those dates to help you figure out what would be the beginning balance and then what is the end balance when you solve back into problems. So consider, is there a beginning balance? And that's your starting point. Add net income from your income statement that you prepared just before this one. Add that in. If there happens to be a net loss, that would be a subtraction. Also, if dividends were paid out, you'll want to subtract that. And then this will present your new ending balance for retained earnings. And that new balance flows into the balance sheet, which is your third statement to prepare. So you can see why you have to prepare these in orders, because the numbers connect and flow from one to the next one. Now, on your balance sheet, you're going to list the balances from 3 categories: the assets, the liabilities, the equities. You will never see your revenues, your expenses, or dividends shown on this report. Also notice that basically, as we move along, except for the very early classes, we truly prepare what is called a classified balance sheet. We don't write the word classified on it, but we do classify it based on current and non-current items. Current would be your current assets that are expected to be used up or become liquid within a year. And those items, like investments that are held for a longer period of time, are non-current. Those things like called intangibles, like patents and copyrights, are typically long-term. They're not going to be categorized as a current. And then items for property, plant, and equipment, or sometimes it's called plant assets, sometimes it's called fixed assets. Those are things like land, building, equipment, machinery, vehicles. Any of those things are expected to have a longer life than a year, so they are non-current, and they will have a separate area as well. So we classify them. On the liability side, same thing. If it's expected to be paid within a year, the resources are going to need to be used within a year to satisfy those liabilities. We classify them as current. If it is long-term, something beyond a year, such as a note that's due in 5 years, then that's going to be long-term. So that would be your classified balance sheet. But again, we don't put the word classified on there. We just do classify it. Note also, for all 3 of these statements, the proper ordering of the accounts is important. Find you some good examples online or in your textbook. And the dating convention does matter. For the first 2, income statement, statement of retained earnings, and for the statement of cash flows, it will show to be for a time period ending, such as for the month ended December 31st and the year, or for the year ended, some time period that has ended for your income statement and retained earnings statements. For your balance sheet and trial balance, this is like a snapshot. It's for a specific date. So on December 31st of that year, these were the balances in these accounts. The dating convention does matter. After you've prepared those financial statements, you prepare post-closing entries, and this is where you're going to close out temporary accounts. Temporary accounts are those that are your revenues, expenses. You close them you make the journal entry to move the amount of the income or loss into the retained earnings account. Often we use the income summary account. You can also go directly into retained earnings account. I have a separate video for closing entries. You will also close dividends, which is considered a temporary account, into the retained earnings account. Now you're ready to prepare a post-closing trial balance. So this lists only the open balances in your permanent accounts, the assets, liabilities, and equities. And at that time, your retained earnings account would have been updated per the closing entries as well. And now you've gotten your, now you've got your books closed and you're reset and ready to start for the next period of time. So this concludes this video for the steps in the accounting cycle.